Our interest.
and getting the interest under control.
You know,
before-
the government really is no different than us in that if we meet with somebody, if we know somebody that's crippled with credit card debt, they're doing all they can just to make those interest payments. They're not getting ahead. They're just treading water.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt Walters here with John Martfeld and Lee Mackey.
Good morning.
Good morning, everyone.
How are you guys?
Good.
We got Christmas next week.
We are a week from Christmas Eve.
I think we're already kind of in Christmas mode because we rolled in this morning. We're like, we don't know what we're talking about on the podcast today.
We're already gone.
So the preparation for today's podcast is less than normal, but we wanted to jump on here.
Which it's not always.
Wanted to jump on here and talk about a few things. Looking back at the last year, man, the Dow is market just opened. Dow's struggling once again. So 9-10 days in a row.
Santa Claus rally may have occurred in November.
Yeah. Yep. So looking back at 2024, what's gone on? So we've had a few things happen. If you haven't been paying attention, what are some highlights looking back in this past year?
Well, I mean, the markets continue to go up in spite of all the rhetoric that it was going to go down.
Let's just. I pulled this up year to date. So we're talking about the year in review, right?
Yeah.
That's what this episode's about. I'm just going to hit some mark. I mean, literally every equity sector for the most part is green. On the low end, foreign stocks are up 7% year to date. On the high end, you have the Russell 1000 growth, 37.5%. This was as of the end of last week. But I mean, you got S&P 29, Dow 18, NASDAQ 34, Russell 2000 17, emerging markets 11, across the board. Fantastic year. I don't care, where you had your money in equities. You may not have performed, equal to the S&P,
right?
But you more than likely had a positive year.
Yes.
Yeah, it's it'd be a hard year to not be positive.
Yeah.
For sure.
Yeah.
S&P 500 value is up only 15%. So value, has continued to underperform. S&P 500 momentum index is up 51%. So momentum growth still outpacing kind of the other factors in the market. So we had a strong year in the market. If you look back, let me pull this up real quick. It's been a good year in the market, but what's interesting is, not what's interesting. It's not all that surprising. But when you look at, the bond market, the bond market's just, it's been a grind for the last few years.
It has.
I mean, you look at BND and AGG. So BND is Vanguard's total bond market ETF. AGG is iShares bond market. Probably, if I were guessing, probably the two largest bond ETFs out there, or at least two of the top largest. And they're both down 1% for the year. If you go back over the last 3 years, they're both down 14%, right? Over the last 5 years, they're still down 12, 13%, right? So there's still, in 2022, when we really saw a sell-off in the fixed income market, and, that's obviously yet to recover. And with the Fed, decreasing just twice thus far this year, it just hasn't been enough to move.
Well, and I think more important than that, I think a lot of people thought that Fed cuts would begin in the summer. They didn't. I think most people at the beginning of the year thought we'd have more than 75 basis point cuts. We have not. But the 10-year has remained pretty strong. Mortgage rates have remained, they dipped after that first 50 basis point drop with the Fed cut. Mortgage rates took a dip, but they're back.
They're back.
They rallied after the second cut.
And then now mortgage rates are back up in the mid 6s to near 7 again. So the bond market has struggled. Now we do feel like that in 25, if we get a series of rate cuts, that bond valuation should increase. But I mean, for the first time now, you're beginning to hear some talk of there may not be as many Fed or rate cuts in 25 as was predicted, just a few weeks ago. Yeah. The economy remains, pretty strong. Inflation is not going away.
Yeah, I think that's going to be the big negative going into 2025 is that we pretend to think inflation's been handled, and it's not.
How concerned are you, either one of you, that with inflation still there, that some of Trump's possible legislation stokes that fire again?
Well, I don't know if anybody, doesn't matter who's in the office, I don't know if there's any way you can stop momentum of what's happening. So I look at it like a different way. One thing that we have to get under control is our deficit and just get our country in order again in Washington, D.C. And so that Department of Government
efficiency
of the E.
DOGE.
I think that department is going to ultimately help the U.S. economy quite a bit but it may not, go into play next year. It might take years for that to actually help the economy. But going back to, like, if you're talking about tariffs and other things that he's threatening to do, and I've heard so many different stories on different business channels and it depends on if you hate Trump or you like Trump, whatever. A lot of times the stories are always bent that way. But on the effects of these tariffs, for example, that everybody's kind of freaked out about. And then I look back at the history of China and how they coupled with us in the 1990s, and they were nothing prior to that. And we have let them into the world economically, right? And they have basically taken advantage of us big time, right? And so it's interesting to note, though, the tariffs that everybody's kind of freaking out about, a lot of them have not been taken off the table even under the Joe Biden administration. Sure. They just aren't advertised because it's not good to say that you've done something that Trump
I think
done.
Biden's increased certain tariffs.
No, I think he has. It's just been underreported, right? And so I don't think these are going to be as major of a problem. That people are thinking that's going to spike inflation based on the fact that you're going to have higher prices when you obviously add a tariff. They're going to add it ultimately to the consumer. I guess the hope is long term is that you bring more production and manufacturing back to the United States. That's one of the main parts of that. So there's obviously, I've heard good and bad, but I don't think that's going to change the course of where we're already heading, in my opinion. That's just my opinion. Yeah.
I mean, I think one thing we've learned over the last few years is that putting a lot of money into the system is stimulative and inflationary.
I
right?
think
and the Fed tweaking and making adjustments to interest rates maybe doesn't have as much of a direct impact as we would have thought a few years ago. I'm not saying it doesn't impact things, but it's not as impactful as a lever as saying, like, hey, here's a few $1 trillion. Everyone go spend it. And it was, it helped us avoid a catastrophic event economically through COVID, right? But now we're seeing the kind of after effects of that, and that's, I think, the driving force with inflation is just the money supply and there's so much money in the system, and so the Fed's in a tight spot. And I think because of that, kind of going back to your question, I think inflation it's not going to be a 1.5% annualized like it has been since the mid 2000s. 3 or 4% a year is probably going to be normal for the next few years,
which is basically normal throughout history.
Right,
we've been spoiled the last.
And regardless of what the Fed does, I don't think they're going to be able to, in any short order, they're going to be able to make a dramatic impact. Because I don't think they had a ton of them increasing rates the way they did. I don't think they had as much of an impact on inflation and bringing inflation down as I think.
Yeah,
they thought they did.
I agree.
I think
I agree.
That was part of it. Just all of the money that had been given out had started working its way through the system. So inflation naturally started, not to come down, but not to continue to accelerate at the same clip that it was.
we're talking we're talking about the past year and looking ahead to 25. For most of this year, we've talked to our clients about the likelihood that the Trump tax cuts, would expire at the end of next year. What do you think the odds are that they get extended beyond 25, given the makeup of Congress?
I think there's a good odds that they get extended, but not permanent. I don't think they become permanent because that was the dream. But you have to have. I think they don't have enough majority to get it permanent. But I'm hopeful that,
they have to extend it.
I think they're gonna.
That's like if they can't get that done,
then they can't get anything done.
It wouldn't surprise me if they extend it, but I think that there will be some tweaks. I think you could see potentially, some of the rates, change a little bit, but
it's interesting. If you look at this is Economics 101, Keynes versus Milton Friedman style of economics, or how you do that. Right now we're in a Keynes scenario with Biden, and it's going to go to a Friedman scenario. And I know people don't know what the heck I'm talking about, but point is, less government is always going to be better, in my opinion, and that's the Friedman way. And so less government typically means that the tax part of that is less taxes. Part of the less government is less taxes needed to fund a government that is less. And I think that the Doge thing is, to me, all that points to less government. And I think that we don't have to raise tax. I think they're going to find a way to get this thing organized by actually doing what all of us would have to do in our household, which is actually have a budget rather than just an unlimited credit card. So I think that there's an opportunity here to
there is, but
keep
if you look
taxes
at the spending, with Doge, and I'm a huge fan of that and want them to do a lot of good work, but our deficit and our spending and our budget issues are not going to be fixed by that. All of those are because of entitlement programs and IOUs that we have that aren't just going to be able to be cleaned up by some Doge,
but Doge can cut.
They can clean up. They can clean things up, but they're not. I say they're not. I would love it if they could.
Yeah.
But if you look at where federal spending is, they're not going to be able to move the needle in a material way from a deficit budget perspective.
So President Reagan had a similar, he called it something different. He had actually created a exact same department to cut government spending, and he was unsuccessful. Basically, for 2 years, they tried, and they could never get anything done because of roadblocks and Washington, D.C., bureaucrats and bureaucracy and so on. And when I look back in the history of that, to your point, there may not be as much room as we hope. The only thing I can say about this current Doge deal, this current thing that we're going to do, is there is so much stuff that we have so much fat in Washington, D.C. So yes, there are a lot of obligations that are not going to go anywhere, but they're going to maybe stop the bleeding.
Sure.
That's the point. Stop the bleeding, reverse some of this is a start.
They just focus on the low-hanging fruit.
Focus on the low-hanging fruit and eliminate some departments and cut some departments in half and so on, which is what they can do. And they can stop the bleeding, and then they can focus on the next hurdle, which would be cutting, stupid spending. But on your point about the money that's going towards Medicare, Medicaid, Social Security, and in our interest on our debt, is basically, I think it's like 76% of our.
Yeah, it is. I just looked at it.
How much is it?
76%.
Is it 76%?
Yeah,
Okay.
76% on interest, healthcare, national defense, Medicare, and Social Security.
Right. So those things can't be necessarily touched, right?
So
you've got
they talk about
24%
getting rid of the
room.
Department of Education. Also, big fan of that.
I am a big fan
Give
of
it back to the states.
Yeah.
But education, training, employment, social services, all of that, 3% of the budget.
I know. It's
right? So
nuts to think about that.
So you go in there
Yeah.
and you say hey, we're going to cut this at the federal level. We're going to cut this spending. We're going to give it back to the states. It's you might move the needle 1 or 2%.
I know.
If you do something drastic.
It's nuts.
Transport, you can go down the list
Yeah.
here, and it's just it's gonna go down to Social Security, Medicare, defense,
Our interest.
and getting the interest under control.
You know,
before-
the government really is no different than us in that if we meet with somebody, if we know somebody that's crippled with credit card debt, they're doing all they can just to make those interest payments. They're not getting ahead. They're just treading water, and so interesting.
Yeah. Well, let's
Interesting.
hope that Trump and his agenda can
Hey,
accomplish
listen, it's
what
better-
they think it can.
It's better than the trek we were on, where
Oh,
it was
sure.
continuous, and just as long as there's again, I'm getting on my little rants here, but we don't have term limits, right? We know that, and term limits would solve a lot of these problems because you would have senators and representatives that weren't worried about getting reelected, and they would actually make hard decisions because hard decisions have to be made at some point to fix some of this stuff. And until we have term limits, in my opinion, you're not going to get hard decisions aren't going to be made because the hard decisions mean you're going to make the voting people upset.
Well,
right? And
the-
some of the decisions you
the
make.
question I've gotten a lot lately over the last few weeks since Trump won, from a lot of conservatives is, well, like what, is the market going to do well now? Yeah. Right? That's kind of one of the most obvious questions
Yeah.
or thoughts. And it's like, well,
Maybe.
the environment, tax wise and regulatory, regulations and all of that, like, should be a better environment for business, but it does not mean the market's going to do better. I mean, if you look at what Biden and right, we talk about from a policy perspective.
Yeah.
You think, okay, the Democrats are, less business friendly. They want higher taxes,
Higher regulation.
and the market's been doing pretty darn well, right? And so
It has, yeah.
it's not, you can never look at it and say like 1 + 1 = 2 when it comes to political issues, who's in control, the economy, and then how the market reacts to all
No
of that.
doubt. Go back to 2009. We have been through President Obama for 8 years. We've been through President Trump for 4. We went through President Biden for 4. And the market has won in each of those times. The market's been ahead at the end of the 4-year term, and it's actually been way ahead. Right. I mean, each term has created growth. So it's not, and now growth that's a little bit, it doesn't necessarily matter like I've always said, the presidential election does not matter as much as we give it credit for. Policies do matter long term. And sometimes we have things that happen. So for example, going back again, 1996, President Clinton passed the Everybody Deserves a Home Act, right? And that single-handedly created, in my opinion, the 2008 financial crisis because it was that was a long-standing buildup of bad situation based on a good policy, right? It was great to give people with lesser means a chance to buy a home, give them the American dream, but ultimately greed and the way banks handled it and the way government handled it screwed it up, right? So in 2008 it unwound and blew up in everybody's face. Well, that is on President Clinton, but people in 2008 might have blamed that on President Bush. And this was 2 terms later, this is so what. Yes, things that have been done under any presidential, any president might actually have negative effects. We just might not feel it for years.
Sure.
So
and typically it's about an 8-year
cycle.
Yeah.
Yeah. Now I will say this: going back to 2008, when the market had that historical drop of 54% in the financial crisis from top to bottom, the market was so oversold by March of 2009 when the market started to come back. That the market comes back, it had nothing to do with policies or who was president or whatever, because the market was just completely oversold. And you have great companies that are making great profit
And
that
investors
were way
that
underpriced.
want to profit off of that.
And now I will flip this to the thing that President Trump is, in my opinion, is the most business friendly president we've had and since Reagan, and it sounds great, and it is, in my opinion, great for regulation and taxes. However, even in Reagan's first couple years, the market did really bad. It wasn't like he came in and magically the market just took off. But he inherited a market that was totally devastated. We had high inflation. We had all these things that his Fed chairman, his things could tackle. And so our interest rates started to plummet. Our economy started to grow. Look what we're inheriting now. You think about it right now. We have very low unemployment rate. We have pretty low historical interest rates, even though people are complaining about them. They're pretty low historically. It's not like we have massive interest rates. Inflation, yes, is a little bit of a booger. But he's inheriting a decent economy, and so your
That's a financial term, by the way.
yeah, booger. So if you're going to go up in, from here, it's not as easy as it was, I guess. My point, there's not as much room. And then I even look at the market like it is overvalued, not as much as it was in 2008, but the market is overvalued according to PE ratios,
Sure.
So on. So to me, it's not as big a runway as Reagan had.
So the
even if
long and short of it
yeah.
is don't, know your risk tolerance and rebalance and stick to it through various, whoever's in office.
Correct.
And the change in administrations, right? I mean, you shouldn't get, in a big way, for sure, you shouldn't get extremely more, risk averse
Sure.
or willing to take risk because someone won an election.
So
Totally agree.
here's a quick question for each of you. And then I want to do a quick prediction, but quickly, without going into a discussion, what do you think the biggest story of 24 was in the financial side? If you had to pick one.
If I had to pick one,
Yeah.
on the financial side, the Fed. I'm guessing.
Okay.
It's probably not, but that's what I would go first.
One single story.
Or artificial intelligence, actually.
Yeah. I don't know.
My-
Fed, inflation.
Mine was the fact that growth continued to far outperform. I mean, we went into 24 thinking, the Magnificent Seven, the growthy stocks would take a back seat to value. Kind of started out that way.
Yeah, we saw some times where the market was broadening out, but then
I mean, yes, and what is at the top of the list again this year?
the
Tech
interesting
names.
thing I've seen
Yeah.
I've seen those, or one podcast that I was listening to, they were talking about going back to the internet age, right? When the internet was coming out, and a lot of your picks and shovels kind of internet providers were like the worst stocks to own, right? And they've done horrible. And then the people who came and ended up building their businesses on the internet and learned how to profit off of the internet, are the Microsofts and the Googles and the best companies in the world today. And so they were making the analogy of like, is AI kind of the same thing? Are the companies that are doing well now actually going to be the best companies long term? Because we're still, in a lot of ways, we're still in the picks and shovels part of the AI boom. And those are the companies that have done the best, but are they going to continue to be able to make the kind of money that they've made? Or will it be the companies that figure out, no, this is how we implement AI, this is how we profit off of it,
Yeah.
but we're not building the chips. We're not,
Correct.
Right.
So it will be interesting.
Oh, I know.
As we over the next 3 to 5 years will be fascinating with
Yeah. Are
the
we
AI
are we
stuff.
going to repeat? The history doesn't repeat itself, but it rhymes. That's a great statement. I don't know who said that, but I like that.
It wasn't you.
It wasn't me. I don't remember who said that. But anyway, well, I like that statement. It may have been from a cartoon. But anyway, if you think about, is 2000, are we going to rhyme with 2000 tech crisis, right? Tech crash, based on this AI just incredible boom of stock. And you look at all these different stocks that have gone up. Just unbelievable amounts in the last several years, but magnified in the last 2. Yeah. That run can't continue. It's
a very different market than it was back in the late 90s.
Completely.
The late
Yeah.
90s, you could throw a dart at a stock and it was going to be up 1,000%.
Yeah,
in the next 2 years.
buyshoes.com,
Yes.
whatever.
And we're not in that environment.
No, it's
because
different, yeah.
The companies that have done the best are the biggest, most profitable, and it's kind of a select few, right? It's not just anybody and everybody.
There are some young, and I'm watching these young AI companies that I think are very, very interesting. Some that are dealing with like the military side, and there's some incredible things happening right now. And so you can see there are some good young companies I'm watching that I think are gonna.
I have literally
performing.
right after this podcast, I have a demo with an AI company.
Really,
Yeah.
that's cool.
This is our last live podcast for the year. So here we go. So currently the S&P is at 6,100. Okay. John, we'll start with you.
Well-
where do you think the S&P is at the end of 25?
Well, let's just put it this way. This is 2,000 points higher than I thought it'd be today a year ago. So my predictions aren't always great. I definitely do not think we're going to continue at this pace. Cannot, will not. I don't care what policies we have in place. I just don't believe it. So
The
I'm
more,
gonna
the more
say
absolute
60.
statements that you use, the better the chances are that it happens.
So-
I know that's true.
Keep
So I
going.
might help the
So
market.
in John
I'm gonna say
Markfeld,
60. I'm gonna say 6,500 on the S&P at the end of
Okay.
2025.
okay, what about
So it's
you?
like 8%.
8%. Yeah.
Yeah.
What are your thoughts?
I'm gonna say, I don't freaking know. My gut, I want to say somewhere between 5 and 10%. I'll say 5%. So that would be, let's call it 6,400.
I'm going to say 6,800, but I'm going to say that most of that is in, if not all of it, is in the first half of the year.
I'm more bearish than John.
Yeah, I know that's not good.
Yeah.
So it's
Well,
it'll be interesting. It'll be interesting to see what the 10-year is. Is it currently at 4.4? Yeah.
We need, the reality of the situation is like, we just need a normal year.
We do.
We need a 5 to 10% year.
I'd be
where-
happy with 3 or 4, honestly.
Yeah.
do you know how many people are coming into my office, and I'm not joking. And this is what happens. And I've been through 2 different down cycles, right? When you're in a high flowing market, the expectations are so out of reach. Sure. I mean, I've had clients come in and say, I want to be conservative, but I want to make like 12% a year. I'm like, well, the S&P has averaged less than 11 for the history of the S&P per year, right? So the fact that we have just been on this roll really since 2009. I mean, we've had 2022 was a blip. It was a horrible year, but it wasn't. We recovered fast.
It wasn't catastrophic,
in 2023.
but
It wasn't
it was a bad
catastrophic.
year.
And it had come off a very good 2021. So
Yeah. So we got 60,
Yeah.
6,400, 6,500, 6,800.
let's get back to normal.
Yeah.
That's the key.
Yes. It's been a good year.
It has been a good
We've made changes with the podcast. We've switched over to a new platform. We haven't run off every listener or viewer,
Yeah.
but
After this podcast, we might. But
yeah, we're looking forward to the new year.
yeah.
We are.
For sure.
So and we should talk about some just real quick sports highlights, right? Scotty Scheffler, best golfer. Kansas City Chiefs won their second Super Bowl in a row last year, start the year. We had Wicked has become this new phenomenal movie that's now going to take over the world, right? Wicked. That came
That's
out in
one of your highlights
2024.
for the year
That's
is
a
Wicked?
highlight. Yeah, and I'd say the hurricane that devastated North Carolina, not just the,
Through
coming
Georgia,
up through
came through
Florida,
Georgia,
but devastated North Carolina is a 100-year flood that they had there, and those people there are suffering still to this day. Asheville, those places aren't back to normal. We had a lot of major things that happened.
Well, we appreciate you guys listening and sticking with us through this year. We're excited about next year and the podcast. As always, give us a like, subscribe, and we will see you guys after the first of the new year.
Merry Christmas.
Merry
Happy
Christmas.
New Year.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. Mach 1 may only transact business in those states in which the firm maintains a notice filing or has qualified for an exemption or exclusion from registration. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com. Thank you for listening to the Market Moment podcast.